Before we dive in, it is critical to understand that this presentation is for educational and informational purposes only. I am not a licensed financial advisor, and the information provided in this video should not be considered legal, financial, or tax advice. Life insurance is a complex product, and your individual needs will vary. Please consult with a qualified, licensed professional before making any financial decisions. Your future is too important to leave to chance, so do your own research and get advice tailored specifically to you. Imagine this for a second. You're 32 years old. You and your partner just closed on your first real house, the one with the decent-sized yard you've been dreaming about. You've got a 5-year-old who's about to start kindergarten and a brand new baby who keeps you up all night. Life is chaotic, it's expensive, it's exhausting, but it's perfect. You have a 30-year mortgage that feels like a mountain, car payments, and the dream of one day sending those kids to college without burying them in debt. You are right in the thick of it, the most financially vulnerable, yet most important years of your life. Now I want you to ask yourself a terrifying question. If you were suddenly gone tomorrow, what happens? I don't mean emotionally, the grief would be unimaginable. I mean financially. On Tuesday, your family is a 2-income household making it work. On Wednesday, they're a 1-income household with all the same bills, a massive mortgage, and the crushing weight of a future that just got terrifyingly uncertain. Could your partner pay for the house, the cars, the food, the daycare all on their own? Would the college funds you just started have to be drained just to keep the lights on? Would the home you just built together have to be sold? This isn't a scare tactic. This is the single biggest financial blind spot for millions of American families. It's the what if that we're all terrified to think about, so we push it to the back of our minds. But what if I told you there is a simple, shockingly affordable financial tool that acts as a fortress around your family's future? A tool that can guarantee, not hope, not wish, but guarantee that the mortgage gets paid, the lights stay on, and the college dreams stay alive, even if you're not there to see it. And what if I told you that for most people in their 20s, 30s, and even early 40s, this protection can cost less than your monthly Netflix and Spotify subscriptions combined? We're talking about 20-year term life insurance. And I know what you might be thinking. Insurance? It's complicated, it's expensive, it's something I'll deal with later. That is exactly what the insurance industry wants you to think. They benefit from the confusion. They build complicated, expensive products that sound good on paper, but often aren't what you actually need. My promise to you in this video is simple. We are going to cut through all of that noise. By the time you finish watching, you will understand exactly how a 20-year term life insurance policy works, why it is the single most powerful financial protection tool for young families, who it's perfect for, who should absolutely avoid it, and how to sidestep the common traps that cost people thousands. We are going to demystify this entire topic so you can make a smart, confident decision for the people you love most. So let's start at the very beginning. What even is term life insurance? The easiest way to think about it is like renting versus buying a house. Term life insurance is like renting protection. You pay a relatively small amount of money, your premium, to have financial protection for a specific period of time or a term. The most common terms are 10, 20, or 30 years. If you pass away during that term, the insurance company pays your family a large, lump sum, and almost always tax-free cash payment called the death benefit. If you outlive the term, which is what everyone hopes for, the policy simply expires. You stop paying and the coverage ends. That's it. It's beautifully simple. Now, you might have heard of other types of life insurance like whole life or universal life. These are the equivalent of buying insurance. They are designed to last your entire life, and they come with a cash value savings component, which sounds great. The problem? They are astronomically more expensive. We're talking 5, 10, even 15 times the cost of a term policy for the same amount of coverage. For the vast majority of people, these policies are a terrible deal, mixing a high-cost, low-return investment with your insurance. We're focusing on term insurance because for 99% of families, it's about getting the maximum amount of protection for the lowest possible cost during the years you need it most. And that brings us to the magic number, 20. Why a 20-year term? Why is that the Goldilocks number for so many people? Go back to that story we started with. The 32-year-old couple with a new house and 2 young kids. A 20-year term policy is designed to build a financial safety net that lasts precisely as long as their period of greatest need. Let's do the math. In 20 years, that 32-year-old will be 52. The new baby will be 20, likely through or well into college. The 5-year-old will be 25, a full-fledged adult, hopefully out on their own. The 30-year mortgage will have only 10 years left, and a significant amount of equity built up. Over those 20 years, they will have had time to save for retirement, build investments, and pay down their largest debts. The 20-year term is a bridge. It's a bridge across the most dangerous financial canyon in your life. The period when your kids are young, your mortgage is new, and your savings are small. It ensures that if something happens to you on that journey, your family doesn't fall into the canyon. They get to the other side safely. By the time the 20-year term ends, you've crossed the bridge. You are largely self-insured. Your kids are grown, the house is mostly paid off, and your retirement accounts are healthy. The massive need for a huge life insurance policy has faded, and the policy expires right on cue. So, how does it actually work in practice? Let's use a real-world example. Let's take a healthy, non-smoking 35-year-old man. He could likely get a 20-year term life insurance policy with a $1 million death benefit for around $40 to $50 a month. Let me repeat that. $1 million. For the price of a couple of pizzas. He pays that premium every month. Let's say, tragically, he passes away in year 7 of the policy. His family files a claim, and the insurance company sends them a check for $1 million tax-free. That money doesn't have to go through the long, complicated probate process with his will. It's paid directly to his beneficiary, his spouse. That $1 million can now be used to pay off the entire mortgage, instantly eliminating the family's single biggest expense. It can be invested to create an income stream to replace his lost salary. It can be set aside to fully fund both kids' college educations. It buys the most valuable thing in the world at a time of crisis. Options. It provides breathing room. It ensures that a personal tragedy does not become a financial catastrophe. Now, what happens if that same 35-year-old pays his premium for all 20 years and is alive and well at age 55? The policy ends. He got nothing back from it, and that is the best-case scenario. You don't want to win at life insurance. You want to pay for the peace of mind that your family is protected, and then you want to live a long, healthy life. Thinking of it as a waste of money is like thinking your car insurance is a waste because you didn't get into a car crash. The value isn't in the payout. It's in the protection and the absolute certainty it provides every single day for 20 years. It's the ability to go to sleep at night knowing that no matter what, the people you love will be okay. So let's pull back the curtain on how this promise, this peace of mind, actually works. How does a simple piece of paper transform into a financial fortress for your family? It's surprisingly straightforward, and it boils down to a simple 3-part contract between you and an insurance company. Think of it as a solemn agreement, locked in a vault for 2 decades. The first part of this agreement is the term. In this case, it's 20 years. This is the duration of the contract. It's a fixed window of time where the promise is active. The best way to think about it is like renting an apartment. When you sign a 1-year lease, you pay your rent every month, and in exchange, you get the absolute right to live in that apartment. You have full protection, a roof over your head. You don't own the building, but for that year, it's your sanctuary. After the year is up, the lease ends. A 20-year term life insurance policy is a lease on financial security. You pay a monthly or annual fee, your premium, and for 20 years you have an ironclad guarantee of protection. Not 19 years and 11 months. Not 20 years and 1 day. Exactly 20 years. This fixed period is the bedrock of the entire concept. It's what makes it so predictable and affordable. The second part of the agreement is the premium. This is your monthly payment, the rent on that financial security. And here is where the magic truly lies. Your premium is level. It is locked in. For the entire 20-year term, your payment will not change. Not by a single penny. Let that sink in for a moment. Think about every other bill you have. Your electricity bill? It goes up. The price of gas for your car? It fluctuates wildly, but the long-term trend is up. Groceries? We all know that story. Even your streaming service subscriptions sneak up in price every couple of years. In a world of financial uncertainty, a level-term premium is a rare and powerful anchor of predictability. You could be 30 years old when you get the policy, and the payment you lock in will be the exact same payment you make when you're 49 and 11 months old. It doesn't matter if you develop a health condition 10 years down the road. It doesn't matter if you switch to a more dangerous job. The deal is the deal. The price is set in stone from day one. This feature alone provides a level of financial stability that is incredibly hard to find anywhere else. It allows you to budget perfectly for 2 decades, knowing this one critical expense will never surprise you. The third and most crucial part of this agreement is the death benefit. This is the whole point. It's the reason the policy exists. This is the lump sum payment that your chosen beneficiaries, your spouse, your children, a trust, receive if you pass away at any point during that 20-year term. And here are the two most important words associated with that benefit: tax-free. The payout is not considered income, so it is not subject to federal income tax. If you have a $1 million policy, your family gets $1 million. The government doesn't get a cut. This is a monumentally important detail. That money arrives as a single, powerful financial tool, ready to be deployed exactly when your family needs it most. It can be used to pay off the mortgage instantly, eliminating the single largest monthly expense from their lives. It can fund college educations, ensuring your children's futures are not derailed by tragedy. It can replace your income for years, giving your spouse the breathing room to grieve and make decisions without the immediate, crushing pressure of having to find a new source of income. It's a financial reset button, pressed at the most difficult moment imaginable. So the core mechanic is simple. You pay a fixed premium for a fixed term of 20 years. If you pass away during that term, your family receives a fixed, tax-free death benefit. But that leads to the next logical question. Why 20 years? Why is that number so common, so popular? It's not arbitrary. The 20-year term is specifically engineered to cover one of the most critical and financially vulnerable periods in a person's life. For most American families, this period is defined by two massive responsibilities: a mortgage and raising children. Let's look at the mortgage first. The classic American mortgage is 30 years. If you buy a house at age 30, you'll be 60 when you finally make that last payment. A 20-year policy taken out at age 30 would protect your family until you're 50. During those 2 decades, you'll have paid down a significant portion of the principal, but a massive balance still remains. The death benefit from a term policy would wipe that debt off the map, guaranteeing your family keeps their home, their stability, and their community no matter what. It removes the threat of foreclosure from the equation during the years when the loan balance is highest. Even more powerful is the connection to raising children. A 20-year term is a near-perfect timeline for a growing family. Imagine a couple has their first child at age 32. They take out a 20-year term policy. That policy doesn't expire until they are 52. By that time, their child will be 20 years old, likely through the most expensive years of their childhood and well on their way through college or starting their own career. The policy acts as a financial safety net stretched out under your children for the entire duration of their dependency. It guarantees that the funds will be there for braces for summer camp, for their first car, and most importantly, for their education even if you're not there to provide them. It's a parent's promise, codified in a contract. This 20-year window also aligns perfectly with a person's prime income earning years. From your 30s to your 50s, you are typically hitting your stride professionally. Your income is growing, but so are your expenses. This is when you are building wealth, saving for retirement in your 401k, and investing. The life insurance policy serves as a backstop. It ensures that your family's lifestyle doesn't have to drastically change and that your long-term financial goals, like your spouse's retirement, remain on track if your income suddenly disappears forever. Now you might be thinking, this sounds great, but what's the catch? How can they promise a massive payout for such a small monthly payment? The answer lies in the underwriting process, which almost always includes a simple medical exam. Don't let that phrase scare you. This isn't an invasive, hours-long ordeal. In most cases, a licensed medical professional comes to your home or office at your convenience. They'll check your height and weight, take your blood pressure, and collect a small blood and urine sample. The whole thing is usually over in less than 30 minutes. The purpose of this exam is simple: risk assessment. The insurance company is making a 20-year bet on your life. They need to understand the odds. The data from your exam, combined with your application answers about your lifestyle, hobbies, and family medical history, allows them to place you into a specific risk class. Are you a non-smoker who runs marathons? You'll be in a preferred class and get the best rates. Are you a bit overweight with high blood pressure? Your rate will be a little higher. This process is actually what keeps term insurance so affordable for so many people. By accurately pricing the risk for each individual, the company can offer incredibly low prices to healthy applicants, rather than charging everyone a high average rate to cover a pool of unknown risks. So, that 30-minute exam is the key that unlocks the lowest possible locked-in premium for the next 20 years. Being honest and transparent in this process is paramount. Any misrepresentation could jeopardize the very payout you're trying to secure for your family. So you go through the application, you complete the quick medical exam, and you're approved. Your policy is issued. The 20-year clock starts ticking. You make your payments and you sleep better at night. But this brings us to the single biggest question people have about term life insurance. It's the elephant in the room. What happens if I do everything right and I live? What happens if I pay my premiums for 20 straight years, the term ends and I'm still here? Did I just waste thousands of dollars on something I never used? It's a fair question, and the answer might surprise you, because in that scenario you didn't lose a thing. You won. You won the ultimate prize. And what happens next, after the 20 years are up, opens up a whole new set of choices and strategies for your financial life. So the clock has run out. 20 years have passed since you first signed on the dotted line. The kids, who were just toddlers then, are now adults, maybe even with kids of their own. The mortgage, that 30-year beast you thought would never die, is either paid off or a shadow of its former self. You've successfully navigated 2 decades of life's uncertainty, with a financial safety net securely in place. You held up your end of the bargain, paying your premiums on time every month for 240 months straight. And the insurance company held up its end, promising to pay out a huge, tax-free sum if the worst happened. But the worst didn't happen. You're still here. You're older, wiser, and hopefully in a much stronger financial position. And then one day an envelope arrives. It's from the life insurance company. It's not a bill. It's a notice. Your 20-year level term period is ending. Suddenly, you're standing at a crossroads. A place you knew was coming but probably didn't think much about. It feels like the end of something, but it's really the beginning of a new set of decisions. In front of you are 3 doors, each leading to a very different financial future. What you choose next is just as important as the decision you made 20 years ago. Let's walk through these doors together. The first door is the most common. It's the simplest. The door is labeled, "Let it go." For the vast majority of people who buy 20-year term life insurance, this is the correct door to walk through. You simply let the policy expire. You stop paying the premiums and the coverage ceases to exist. It's over. Done. That chapter of your life is closed. Now, for a lot of people, this feels strange. Feels like a loss. You think, I paid all that money for 20 years for nothing? But remember what we said before. You didn't get nothing. You got peace of mind. You got the certainty that your family would have been okay. You bought a 20-year-long promise, and that promise was fulfilled. The fact that the catastrophic event didn't happen is the outcome you were paying for. Walking through this door means you've successfully reached a point called self-insurance. It's a beautiful concept. It means you've built up enough wealth, through your 401k, your home equity, your savings, your investments, that you no longer need a life insurance company to backstop your family's future. If you were to pass away now, your spouse would have enough assets to live comfortably. Your financial obligations are minimal. The kids are independent. The house is paid for. The primary reason you bought the policy in the first place, to replace your income and cover massive debts, no longer exists. You've graduated. You've won the game. Letting the policy expire isn't quitting. It's declaring victory. You take the money you were spending on premiums, maybe $100 a month, and you can now redirect it. Put it toward your retirement, use it to travel, spoil your grandkids. The choice is yours, and that freedom is the reward for 20 years of diligent planning. So door number 1 is the graceful exit, the planned conclusion. But what if you're not there yet? What if things didn't go exactly to plan? Maybe you had another child later in life. Maybe you took on a new business loan. Or maybe you just don't feel comfortable without that safety net. You're standing at the crossroads, and you're not ready to let it go. This brings us to door number 2. This door looks familiar. It's labeled, Renew. On the surface, this seems like a great option. You liked your policy, you trust the company, you just want to keep it going. The letter from your insurance company will probably present this as a seamless option. It might say something like, Good news! You can continue your coverage without any medical exams or applications. And your first thought is, Perfect! I'll just keep paying what I was paying. And this is where the trap is sprung. This is one of the most important and shocking lessons about term insurance. When you renew your policy after the initial term, you are not renewing it at the same price. You're not even renewing it at a slightly higher price. You are renewing it at a catastrophically higher price. Let's be crystal clear. That $50 a month you were paying for $1 million policy at age 35? At age 55, the insurance company isn't seeing you as a healthy 35-year-old anymore. They are seeing you as a 55-year-old, which, actuarially speaking, is a much riskier bet. The price you were paying was locked in or level for 20 years. That level period is over. Your policy now typically converts to something called an annual renewable term, or ART. This means you can keep the policy, but the price will go up every single year. And the first year's jump is a monster. That $50 a month premium could easily become $500 a month, or more. The next year it might be $580. The year after, $670. It's designed to be so expensive that it pushes you out the door. Why do they do this? It's simple risk management. The only people who would willingly choose to pay 10 or 20 times their original premium are people who have a strong reason to believe they might need the policy soon, meaning they're in poor health. This is called adverse selection. The insurance company knows that only their sickest, highest risk clients will choose this option. So they have to price it accordingly to cover the near certainty of a payout. So door number 2 isn't really a long-term solution. It's a temporary, extremely expensive bridge. It might make sense for a few months if you're in the process of getting a new, different policy and need to avoid a gap in coverage. But for 99% of people, renewing your old term policy at the new, inflated rates is a financial disaster. It's a door that looks inviting, but it leads to a cliff. This leaves us with the third and final door. This one is the most interesting, the most nuanced, and the one that holds a secret power you probably didn't even know you had. This door is labeled convert. Almost all term life insurance policies come with a special feature baked into the contract. It's called a conversion privilege. This privilege is your golden ticket. It gives you the right to trade in or convert your temporary term policy for a permanent policy, like whole life or universal life, without having to prove your insurability. Let me say that again because it is that important, without any medical exams. No blood tests, no urine samples, no answering 100 questions about your health history. You could have been diagnosed with a serious illness in year 19 of your 20-year term. You could now be completely uninsurable on the open market. No other company would touch you. But because of this conversion privilege, your current insurance company is contractually obligated to give you a brand new permanent policy. They have to honor the health rating you had 20 years ago when you were younger and healthier. This is a game changer. Why would someone do this? Let's go back to our story. Imagine during that 20-year term you developed a chronic condition. You're now 55, but you know for sure you won't be able to get new insurance. But you still have needs. Maybe you have a special needs child who will require care for the rest of their life. Or maybe you want to leave a guaranteed inheritance to your kids or a charity, a legacy that will absolutely be there no matter what. Or perhaps you need a way to pay for estate taxes down the road. In these scenarios, a temporary policy that's about to expire doesn't solve your problem. You need coverage that will last for the rest of your life. And that's what a permanent policy does. By converting your term policy, you lock in lifelong coverage that can never be canceled as long as you pay the premiums. Now, it's not a free lunch. The premiums for the new permanent policy will be higher than what you were paying for your term policy. Of course they will be. A policy designed to last your whole life is going to cost more than one designed to last 20 years. The price will be based on your current age, your age at conversion, but on your original health class. So, if you're 55, you'll pay the rates for a 55-year-old, but you'll get the preferred plus health rating of the 35-year-old you used to be. For someone with health problems, this is the only way to get permanent coverage. It's an incredibly powerful tool. You usually don't have to convert the entire death benefit either. If you had $1 million term policy, you might choose to convert just $100,000 or $250,000 of it into a permanent policy, just enough to cover final expenses, pay off some small debts, and leave a small legacy. This makes the premium much more manageable. So those are your 3 doors when your 20 years are up. Door number 1. Let it expire, celebrating your financial independence. Door number 2. Renew and face cripplingly high premiums for a short-term fix. Or door number 3. Convert, using your golden ticket to secure lifelong coverage, regardless of your health. The right choice depends entirely on where you are in life when that 20th year comes to a close. It requires an honest look at your health, your wealth, and what you want your money to do for you and your family in the next chapter of your life. And making that decision, well, that's where the real strategy begins. Because there are layers to this that most people never even consider. Let's start with the most common path people take when their 20-year term ends. They do nothing. They simply let the policy expire. On the surface, this seems like the logical conclusion. You bought a 20-year contract, the 20 years are up, contract over. You stop paying the premiums, and the insurance company is no longer on the hook. Mission accomplished, right? For many people, this is exactly the right move. If your kids are grown and financially independent, if your mortgage is paid off, and if you've built a substantial nest egg that can support your spouse or dependents, then you may have successfully outlived your need for life insurance. You've become self-insured. That was the whole point of the 20-year plan. But here's the psychological trap that snares so many people. They look back at 20 years of payments, let's say $50 a month for 20 years, that's $12,000, and they think, I paid all that money and got nothing for it. This is a fundamental misunderstanding of what insurance is. You didn't get nothing. You got 20 years of uninterrupted peace of mind. You got the guaranteed security that if the worst had happened on any given day during those 2 decades, your family's financial world would not have collapsed. You weren't buying a lottery ticket, you were buying a fortress. The best case scenario with life insurance is that you never have to use it. So letting it expire isn't a loss, it can be a victory. It means your plan worked. However, choosing this path is a massive gamble if your financial situation hasn't changed. If you still have debt, if your spouse still relies on your income, or if your savings aren't where you hope they'd be, letting that policy expire is like canceling your fire insurance because your house hasn't burned down yet. You're removing the single most important safety net, often at a time in life when your health is becoming less certain. This leads us to the second option, which sounds simple but is one of the most misunderstood and dangerous traps in the insurance world: renewing the policy. Most term policies come with a feature called a guaranteed renewal provision. It sounds great, doesn't it? It means that at the end of your 20-year term, the insurance company guarantees you the right to renew your coverage, usually on a year-by-year basis, without having to prove you're in good health. No new medical exam, no questions asked. You can keep your coverage. So what's the catch? The price. The guarantee is only on your eligibility for coverage, not on your premium. And the new premium isn't just a little higher. It's astronomically, catastrophically higher. Why? Because the entire risk calculation has changed. When you first bought the policy at, say, age 35, the insurance company was betting on the high probability that a healthy 35-year-old would live for the next 20 years. Now you're 55. The risk of you passing away in the next year is significantly higher than it was at 35. The insurance company knows this, and they will price that risk accordingly. That $50 a month premium you were used to? It could easily jump to $500, $600, or even $1,000 a month for the exact same death benefit. The renewal provision isn't designed to be an affordable, long-term strategy. It's an emergency last resort option for someone who has become critically ill near the end of their term and has no other choice. It's a financial lifeline, but a very, very expensive one. Relying on it as your primary plan for what to do after 20 years is a recipe for financial disaster. It's the option of last resort, not the plan. So, if letting it expire is too risky and renewing it is too expensive, what's left? This brings us to the third option, the one that contains a hidden power that most policyholders don't even know they have. It's called the conversion privilege. Buried in the fine print of many, though not all, term life insurance policies is a clause that gives you a truly incredible superpower: the right to convert your term policy into a permanent policy, like whole life or universal life, without a new medical exam. Let me say that again because it is the most important part of this entire discussion. Without a new medical exam. This is a game changer. Imagine this scenario. You buy your 20-year term policy at age 30. You're in perfect health. At age 48, 2 years before your policy expires, you have a heart attack or are diagnosed with cancer. Suddenly, you are completely uninsurable on the open market. No insurance company would even consider giving you a new policy. Your 20-year term is about to end, and you're facing the terrifying prospect of leaving your family with zero protection. But then you remember the conversion privilege. This clause acts as a time machine. It allows you to exercise your right to get permanent coverage based on the clean bill of health you had 20 years ago. The insurance company cannot deny you. They cannot ask you a single health question. They must issue you a permanent policy. This single privilege can be the difference between your family's security and their financial ruin. It is your golden ticket. When you convert, you're essentially trading in your temporary term policy for a permanent one. This new policy will last for the rest of your life, as long as you pay the premiums. It won't expire. It also comes with a feature that term insurance doesn't have: a cash value savings component that grows over time, tax deferred. Now let's be brutally honest. Just like the renewal option, this is not cheap. The premiums for the new, permanent policy will be significantly higher than your old term premium. But there's a critical difference. With the renewal, you're paying an outrageous price for the same temporary coverage. With a conversion, you are paying a higher but fairly calculated price for a much more valuable product, lifelong coverage plus a cash value asset. The new premium is based on your age at the time of conversion, in our example age 50, but on your health class from 20 years ago. This is the crucial benefit. You're getting the best of both worlds. Pricing that reflects your original good health, applied to a new permanent product at your current age. So who is this for? The conversion privilege is the perfect strategy for someone whose health has changed for the worse during their term. It's for the person who is now uninsurable, but still has a profound need for life insurance. It's also for someone who has decided they want or need coverage for their entire life, perhaps for estate planning, to leave a legacy, or to cover final expenses, and wants to lock it in without rolling the dice on a new health exam. Choosing to convert isn't a simple decision. It requires a hard look at your budget, your long-term financial goals, and the specific terms of your policy. Not all policies offer it, and those that do have a specific window of time when you can exercise the right. You can't just wait until the last day of your term. You have to be proactive. These three paths, letting it expire, renewing at a high cost, or converting to a permanent policy, represent the standard playbook. Each one is a direct response to a fundamental question. Has your life and your need for financial protection changed over the last 20 years? But what if your health is still good and you still need coverage, but the cost of converting to a permanent plan is just too steep? What if you're stuck in the middle? This is where most people get paralyzed. They feel trapped. But there is another way. There's a fourth option, a hybrid strategy that combines the best elements of these choices. And it's a strategy that can save you an incredible amount of money while keeping your family protected. And understanding how to navigate that path, that requires a different kind of thinking entirely. This different kind of thinking isn't about finding a secret magical insurance product that no one's ever heard of. It's about seeing the products that are already in front of you, like the standard 20-year term policy. Not as rigid one-size-fits-all solutions, but as building blocks. Financial Legos, if you will. The goal is to stop thinking, how much insurance do I need for the next 20 years? And start asking, how do my financial needs change over the next 20 or 30 years? Because they absolutely will. Your need for life insurance is not a flat line. It's a mountain. It starts low, rises steeply as you take on more responsibility, peaks during your most vulnerable years, and then gradually slopes back down as you become more financially independent. A single massive term policy treats that mountain like a giant plateau. It forces you to pay for peak-level coverage for the entire duration, even long after the peak has passed. You're paying for $1 million of protection in year 19 when you might only need a fraction of that. The strategy that aligns your coverage with the actual shape of your financial mountain is called laddering, or sometimes layering. And it is, without a doubt, one of the most powerful and cost-effective ways for a young family to secure their future. The concept is brilliantly simple. Instead of buying one large life insurance policy for a long term, you buy multiple smaller policies with different term lengths that overlap. As your financial needs decrease over time, the smaller, shorter-term policies expire, and your total coverage and your total premium steps down to match your new lower need. You're trimming the fat in real time. Let's make this real. Forget abstract theories. Let's talk about a couple. We'll call them Mike and Jessica. They're both 32 years old. They just had their first child, a little girl named Emily. They bought a house last year with a 30-year mortgage of $450,000. They also have a combined $60,000 in student loan debt. Their goal is to make sure that if one of them were to pass away unexpectedly, the other could pay off the entire mortgage, eliminate all debt, and have a substantial fund to help raise Emily and send her to college. They add it all up. The $450,000 mortgage, the $60,000 in student loans. They figure they'd need at least another $500,000 to replace lost income and fund college. So they land on a number, $1 million. That's their peak need. So, the conventional wisdom says they should go out and buy a $1 million 30-year term policy. This would cover them until their mortgage is paid off and Emily is well into her 20s. It's simple, it's clean, and it feels safe. But is it smart? Let's look at their financial mountain. For the next 10 years, their need is absolutely at its peak. The mortgage balance is at its highest. Emily is completely dependent on them. They have very little saved for college. That $1 million of coverage is critical. But what about 15 years from now? Mike and Jessica will be 47. they'll have paid down a significant chunk of their mortgage. Let's say the balance is now $280,000. Their student loans are long gone. Emily is 16 and they've hopefully been saving for college so that nest egg is growing. They've also been contributing to their 401(k)s for 15 more years. Their net worth has grown. Do they still need the full $1 million in coverage? No. Their need has probably dropped to something closer to $700,000. Yet, with that single 30-year policy, they're still paying the premium for the full million. Now fast forward again. It's 25 years from now. They're 57. The mortgage has only 5 years left. Emily has finished college. Their retirement accounts are substantial. They are on the cusp of financial independence. Their need for life insurance might be as low as $250,000, just enough to clear the last bit of the mortgage and provide a small buffer. But they are still paying the premium on that original $1 million policy. They've been overpaying, relative to their needs, for more than a decade. This is where laddering changes the entire game. Instead of buying that one big policy, Mike and Jessica's advisor shows them a different path. They break down their $1 million need into layers. Layer 1 is the foundation. This is their long-term need. They decide they want at least some coverage until the mortgage is completely gone. So, they buy a $250,000 30-year term policy. This is their base layer. Their financial safety net that lasts the entire journey. Layer 2 covers the expensive middle years. This is when the kids are in their teens, college costs are looming, and the mortgage is still a major burden. Their need is still high but not at its peak. So, they add a $450,000 20-year term policy on top of the first one. This policy is specifically designed to disappear right around the time Emily graduates from college, and their mortgage balance becomes far more manageable. Layer 3 is for the danger zone, the first decade. This is when they are most vulnerable. Maximum debt, zero college savings, a completely dependent child. To cover this peak risk, they add a final, smaller policy. A $300,000 10-year term policy. This is their booster pack, providing extra protection when they need it most. Now let's look at what they've built. For the first 10 years, they have all three policies active. $250,000 plus $450,000 plus $300,000. That's $1 million in total coverage, exactly what they need during their highest risk period. Then, at year 11, something beautiful happens. The 10-year, $300,000 policy simply expires. It's done its job. And with it, the premium for that policy vanishes. Mike and Jessica's total coverage automatically steps down to $700,000. $250,000 plus $450,000, which perfectly aligns with their reduced need. They are no longer paying for coverage they don't need. 10 years later, at the 21-year mark, the next step down occurs. The 20-year, $450,000 policy expires. Again, its job is done. The premium for that policy disappears. Now, for the final 10 years of their plan, they're left with just the foundational $250,000 30-year policy. Their coverage perfectly matches their needs in their late 50s, and their monthly cost is now a fraction of what it once was. The result? By laddering, they get the exact same protection, or arguably more appropriate protection, than the single $1 million policy, but the total cost over the 30 years is significantly lower. We're often talking about savings of 20, 30, even 50% over the life of the policies. That's thousands or even tens of thousands of dollars that they can now use for other goals, investing more for retirement, saving more for college, or just enjoying their lives. This strategy reframes the purpose of a 20-year term policy. It's no longer just a standalone solution. It becomes the workhorse of your financial plan. It's the crucial middle layer that protects your family during the most expensive and demanding years of raising children. It bridges the gap between the short-term vulnerability of new parenthood and the long-term security of a nearly paid-off mortgage and healthy retirement savings. Now, you might be thinking this sounds more complicated. And yes, it requires a little more thought up front than just picking a number and a term. You have to actually map out your future financial needs. But the effort is minuscule compared to the potential savings and the precision of the protection you're creating. It's the difference between using a sledgehammer and a scalpel. Both can get a job done, but one is far more intelligent and efficient. This isn't just about buying insurance. It's about designing a financial shield that shrinks as your own financial strength grows. So the concept is clear. Laddering saves money and provides tailored protection. But this is where theory meets reality, and reality is full of pitfalls. The process of actually applying for and getting approved for multiple policies has its own set of rules and hidden traps. The medical exam, the questions you answer, the companies you choose, every single step matters. And making a mistake in the application process can either get you denied or lock you into higher rates for decades, completely wiping out the savings you were trying to create. The strategy is brilliant, but the execution, that's where the real secrets are. So let's pull back the curtain on that execution. The life insurance application isn't just a form you fill out. It's the opening argument in a negotiation for your financial future. It's your one chance to present the best, most accurate version of yourself to the underwriter, the person in a quiet office who will never meet you, but who will decide how much you pay for the next 20 years based on the story you tell them on paper and in a blood test. This entire process, from the moment you sign the application to the moment a policy is approved, is called underwriting. And it rests on 3 core pillars. Get these 3 pillars right, and you're on your way to the best possible rate. Get one of them wrong, and you could be leaving thousands of dollars on the table. The first pillar is the application itself. This is your written testimony. The single most important rule here is brutal, unflinching honesty. You might be tempted to shave a few pounds off your weight, or forget to mention you tried smoking in college, or downplay that one time your doctor mentioned your blood pressure was a little high. Don't. Just don't. Insurers have a tool that's essentially the life insurance equivalent of a credit bureau. It's called the MIB, or the Medical Information Bureau. Every time you apply for life, health, or disability insurance, a record is created. If you told one company you had a certain condition, and you forget to tell the next company, the MIB will light up like a Christmas tree on the underwriter's desk. It's the fastest way to get your application flagged, heavily scrutinized, or outright denied. Worse, let's say a small lie slips through. You say you're not a smoker, but you enjoy a celebratory cigar a few times a year. You get the best preferred plus non-smoker rates. You save $100 a month. You feel brilliant. 10 years later, you pass away from a heart attack. The insurance company launches a routine claim investigation. They pull your medical records and see a note from your doctor from 8 years ago that says, "Patient is a social smoker, cigars on occasion." Guess what happens? They can, and often will, deny the entire death claim based on material misrepresentation. Your family, who was counting on that $500,000 safety net, gets nothing. You save $12,000 in premiums over 10 years, only to have your family lose $500,000. It is the single worst trade you could ever make. So honesty is non-negotiable, but that doesn't mean you can't be smart. The art is in providing context. The application might ask, have any of your immediate family members died of cancer before age 60? A simple yes is a red flag. But if you can add context, yes, my father passed from skin cancer at age 58, but he was a farmer who worked outside his entire life with no sun protection. That context is critical. It tells the underwriter that the risk may have been environmental, not genetic. Be honest, but be thorough. Don't let a yes or no box tell a story that isn't true. Now for the second pillar, and this is where you have an incredible amount of control, the paramedical exam. This is when a nurse comes to your home or office to take your height, weight, blood pressure, and a blood and urine sample. Most people treat this like any other medical appointment. This is a huge mistake. This isn't a checkup for your health. It's a one-time snapshot for a financial product. Your only goal is to make that snapshot as perfect as humanly possible. Think of it like preparing for a big race. You wouldn't roll out of bed and run a marathon. You train, hydrate, and eat right. The 2 days leading up to your exam are your training period. For 48 to 72 hours before the exam, you need to be strategic. First, avoid strenuous exercise. That intense CrossFit workout or long run can temporarily elevate your liver enzyme levels, which can look like a sign of liver damage to an underwriter. Second, cut out salty, fatty, and fried foods. That bacon cheeseburger can cause temporary spikes in your cholesterol and triglyceride readings. Third, and this is a big one, avoid all alcohol. Alcohol dehydrates you, which can concentrate the components in your blood and urine, and it can also mess with those same liver enzymes. The night before your exam, you should fast for at least 8 to 12 hours. This is crucial for getting an accurate reading on your blood sugar and cholesterol levels. Drink plenty of water during this period. Being well hydrated makes it easier to draw blood and can slightly improve many of your readings. On the morning of the exam, do not, under any circumstances, drink coffee or any other caffeine. It's a vasoconstrictor, meaning it tightens your blood vessels and will absolutely raise your blood pressure reading. Schedule the exam for as early in the morning as you can. You'll be fully rested, fully fasted, and your blood pressure is naturally at its lowest. Right before the nurse arrives, don't rush around cleaning the house. Sit down. Breathe deeply for 5 minutes. Be calm and relaxed. When she takes your blood pressure, you want it to be the lowest, most boring reading she's seen all week. Following this simple protocol can literally be the difference between a standard rating and a preferred rating, saving you 25% or more on your premiums for the next 20 years. That brings us to the third and final pillar, the one most people don't even know exists: the attending physician's statement, or APS. If you have any pre-existing conditions, or you're applying for a very large amount of insurance, the underwriter will almost certainly request your medical records directly from your doctor's office. This is your medical history written by someone else, and the story it tells is profoundly important. Here's the secret. You need to become the co-author of that story. The next time you have your annual physical, tell your doctor, "By the way, I'm planning on applying for life insurance soon to protect my family." This simple statement changes everything. It puts them on notice that their notes will be scrutinized by a third party. Now you can work with them to make sure your records are accurate and reflect the positive things you're doing. If you've lost weight, ask them to note it. If you've lowered your cholesterol through diet, make sure the note says, "Patient is compliant with diet and has successfully lowered LDL." If you're on blood pressure medication, you want the record to show, "Patient's hypertension is well controlled with medication." Imagine two people, both with high blood pressure. The first person's file just has a series of high readings. The second person's file has notes that show they are actively managing the condition, taking their medicine, and have brought their readings down into a healthy range. To an underwriter, the first person is a high risk. The second person is a responsible, low risk. They have the exact same condition, but they will get dramatically different insurance rates, all because of the story told in their medical records. Mastering these three pillars, the honest and detailed application, the perfectly prepared paramedical exam, and the proactively managed medical record, is the foundation of securing the lowest possible premium. You are building a case for why you are an excellent risk. You're leaving no room for doubt or negative interpretation. You are taking control of the narrative. But what happens when you do everything right? You build the perfect case, and the insurance company still comes back with an offer that's higher than you expected. Most people just sigh and either accept the higher rate or walk away from getting coverage altogether. But this is another critical mistake. The initial offer isn't the end of the negotiation. In many cases, it's just the beginning. And knowing how to challenge and appeal their decision, that is the final secret to getting the rate you truly deserve. Let's unpack that. Imagine a guy named David. David is 35, a non-smoker in great shape. He runs a few miles every week, eats relatively healthy, and his agent gives him a quote for $1 million, 20-year term policy at a preferred plus rate. The price is fantastic. He's feeling great. He does the application, takes the medical exam, and waits. A few weeks later, the final offer comes in the mail. He opens it and his heart sinks. The rate isn't preferred plus. It's not even preferred. They've rated him as standard, and the premium is nearly double the original quote. What happened? David is confused, frustrated, and a little insulted. His first instinct, and the instinct of 99% of people in this situation, is to do one of two things. Either he begrudgingly accepts the higher rate thinking, "Well, I guess this is the best I can get," or he gets angry, says "forget it," and throws the offer in the trash, leaving his family unprotected. Both of these are losing moves. What David doesn't know is that he's just entered the most important phase of the buying process: the appeal. The insurance company isn't a black box that spits out a decision you have to live with. It's a company staffed by human underwriters who make judgments based on the limited data they have in front of them. Your job, with the help of your agent, is to give them better data. The very first step is not to get angry, it's to get curious. You need to call your agent immediately and ask the magic question. Why? Not in an accusatory way, but in a forensic way. You need to say, "Can you please find out the exact reason for the standard rating? I need to see the specific data points the underwriter used to make their decision." A good agent will be able to get this information for you. They can request the underwriter's notes. Let's say in David's case, the agent calls back and says, "Okay, here's the deal. Your blood pressure was a little high on the day of the exam, 142/90. Their cutoff for preferred is 135/85. Also, your cholesterol came back slightly elevated." Now David has the key. He's no longer in the dark. He remembers that he was stressed on the day of the exam. He had a huge work deadline, drank 3 cups of coffee right before the nurse arrived, and was running late. Of course, his blood pressure was high. And the cholesterol? He remembers he had a massive steak and fries with his buddies the night before the exam. It was a one-time thing. This is not an insurmountable problem. This is a data problem. The underwriter only has a single snapshot in time, and on that particular Tuesday morning, David's snapshot looked standard. Now it's time to paint a more accurate picture. This is where you go on the offensive. The process is called a reconsideration request. David's agent tells him what he needs to do. First, go to his own primary care doctor. Get his blood pressure checked in a relaxed environment a few different times over a week. His doctor records the readings, and they're all perfectly normal around 120/80. Second, his doctor orders a new blood panel. This time, after avoiding that celebratory steak dinner, David's cholesterol levels are well within the preferred plus range. But here's the most powerful piece of the puzzle: a cover letter from his own doctor. The agent helps David get a letter from his physician addressed to the insurance underwriter. The letter states something like, "I have been David's physician for 7 years. The blood pressure reading of 142/90 recorded during your exam is not representative of his typical health. My records consistently show his blood pressure in the 120/80 range. Furthermore, his recent lab work attached shows his cholesterol is well managed. In my professional opinion, David is in excellent health and represents a very low mortality risk." This is a bombshell. The underwriter is no longer just looking at their own isolated, out-of-context data. They now have a multi-year testament from a medical professional, plus new, favorable data to support it. The agent packages all of this, the new blood pressure readings, the new lab results, the doctor's letter, and formally submits it to the insurance company with a request to reconsider the standard rating. What happens next? In many cases, the underwriter reviews the new information and agrees. They needed a documented medical reason to overturn their initial decision, and now they have one. They can justify the upgrade. They change David's rating to preferred, or maybe even preferred plus. His premium is cut nearly in half, saving him over $10,000 over the life of the 20-year term. All because he didn't take the first no as the final answer. He challenged the data. This applies to so many situations. Maybe it's not blood pressure. Maybe it's your family history. You noted that your father passed away at age 58 from a heart attack, which is a huge red flag for underwriters. But what the application didn't have space to explain was that your father was a lifelong smoker who worked in a coal mine and never exercised. You, on the other hand, are a non-smoking marathon runner. A detailed letter explaining the lifestyle differences, perhaps with a note from your doctor about your own outstanding cardiovascular health, can completely recontextualize that family history and lead to a better rating. Or maybe they found something in your medical records that looks scary but is actually benign. You had a series of tests done a few years ago for a health scare that turned out to be nothing. But to the underwriter, a series of tests for, say, a neurological issue looks like a risk, even if the final diagnosis was perfectly healthy. Again, you provide context. You get the records from that specialist visit, including the final report that gave you the all clear, and you submit it. You are filling in the gaps in your own story. But what if you do all this and the original insurance company still won't budge? They're stuck on their initial decision. Is it over then? Absolutely not. This is where a good independent broker becomes your secret weapon. Because here's what happens next. Your broker takes your entire file, the original application, the initial bad offer, and most importantly, all the new evidence you just gathered, and they go to a different insurance company. They can now lead the conversation with your strengths. They can say to the underwriter at Carrier B, "Listen, I have a client, David. Carrier A offered him standard because of a one-time high blood pressure reading. But here is a letter from his doctor of 7 years, plus a series of new readings and lab work showing he is in phenomenal health. What can you do for him?" This is a game changer. You are now comparison shopping with a fully prepared, evidence-backed case file. Carrier B isn't starting from scratch. They can see exactly why Carrier A made their decision, and they can also see the compelling new evidence that refutes it. It's very common for a competing carrier to look at the exact same file and come to a wildly different conclusion, offering you the preferred rate you deserved from the start. They see an opportunity to win a great client that their competitor misjudged. The key takeaway is this: the initial offer is not a verdict. It is an opening bid based on incomplete information. It's a snapshot, not the full movie of your health. Too many people walk away from the table, either by overpaying or by giving up entirely. But the power to change the outcome is almost always in your hands. You have to be your own advocate. You have to be willing to question the result, gather the evidence, and make your case. By understanding that you can appeal, that you can provide new context, and that you can shop your case to other carriers, you fundamentally shift the balance of power from the insurance company back to yourself. And that single realization is the difference between a frustrating, expensive process and one where you end up with the right coverage at a truly fair price. So let's pull back the curtain on the single most misunderstood, and frankly, the most important part of buying term life insurance, the underwriting process. This is the black box. It's the mysterious behind-the-scenes evaluation that determines whether you get approved and, crucially, how much you're going to pay. Most people think of it as a simple pass/fail medical test. But it's not. It's a negotiation. It's a discovery process. And when you understand how it works, you can prepare for it, you can navigate it, and you can influence the outcome in your favor. Underwriting is simply the insurance company's process of figuring out how risky you are to insure. That's it. They're trying to predict your life expectancy based on data. The more data they have that suggests you will live a long, healthy life, the lower your risk. The lower your risk, the lower your premium. Your entire goal during this process is to present yourself as the lowest possible risk, honestly. It all starts with the application. This isn't just paperwork. It's the opening chapter of your story. It's your official statement to the insurance company. You'll be asked dozens of questions about your health, your family's health history, your lifestyle, your hobbies, and your finances. The temptation for some is to fudge the numbers, to say you smoke a little less than you do, or to forget about that one time you were treated for high blood pressure. This is a catastrophic mistake. Insurance companies operate on a legal principle called utmost good faith, but they verify everything. Lying on your application is considered material misrepresentation. If you die during the first 2 years of the policy, a period known as the contestability period, the company will launch a full-scale investigation. If they find you lied about being a smoker or about a diagnosed heart condition, they will deny the death claim. They'll refund the premiums paid, but your family gets nothing. Imagine your loved ones, in the worst moment of their lives, discovering that the financial safety net you promised them was built on a lie and is now gone. It's not worth it. Be honest. Be thorough. The next and most well-known step is the paramedical exam. A nurse or a phlebotomist, usually contracted by the insurance company, will come to your home or office. It's convenient and it's free for you. They'll take your height, weight, and blood pressure, and they'll collect blood and urine samples. This isn't a full physical. They're not diagnosing you with anything. They are simply collecting data points for the underwriter. And this is your first real opportunity to influence the outcome. The results of this one exam can literally be the difference between a rate of $30 a month and $100 a month. So you need to prepare for it like you're an athlete preparing for game day. For at least 24 to 48 hours before the exam, you want to do a few things. First, drink a lot of water. Being well hydrated makes it easier to draw blood and can help flush your system, potentially improving your lab results. Second, avoid alcohol, caffeine, and strenuous exercise. Alcohol can affect your liver enzyme readings. Caffeine can temporarily spike your blood pressure, and a heavy workout can elevate protein levels in your urine, which can be a red flag for kidney issues, even if you're perfectly healthy. Third, fast for at least 8 to 12 hours beforehand. This ensures the most accurate reading of your cholesterol and glucose levels. A big fatty meal the night before can artificially inflate your triglycerides and give a completely false picture of your health. Schedule your exam for first thing in the morning. This makes fasting easy, you just sleep through most of it. By taking these simple steps, you are presenting the underwriter with the best, most accurate snapshot of your health. But the exam is just one piece of the puzzle. The underwriter is also a detective, and they have access to databases you've probably never even heard of. The first is the MIB, or the Medical Information Bureau. Think of it like a credit bureau but for insurance applications. It's a non-profit organization funded by insurance companies. When you apply for insurance, the company can check the MIB database to see information you've submitted on previous applications. If you told one company 3 years ago that you had sleep apnea, but you forget to mention it on your current application, the MIB report will expose that inconsistency. It's a system designed to prevent fraud and keep applicants honest across the board. Next, they'll pull your prescription history, sometimes called an RX report. Yes, they have a way of seeing a comprehensive list of medications that have been prescribed to you. If you say you're in perfect health but your RX report shows prescriptions for insulin, heart medication, and an antidepressant, the underwriter is going to have some serious questions. This is another reason why honesty on the application is non-negotiable. They will find out. The goal isn't to hide your health conditions. It's to show that you are proactively managing them. Someone who takes their blood pressure medication consistently is a much better risk than someone who has untreated high blood pressure. They will also pull your motor vehicle report, or MVR. Your driving record is a surprisingly accurate predictor of risk-taking behavior. A recent DUI, multiple speeding tickets, or a history of reckless driving tells an underwriter that you might be a bigger risk, not just behind the wheel, but in other aspects of your life as well. A clean driving record reinforces the story that you are a responsible, low-risk individual. So the underwriter gathers all this information: your application, your paramedical exam results, your MIB report, your prescription history, and your driving record. They put it all together and they run it through their actuarial tables, these massive complex datasets that predict life expectancy. The result of this analysis is that they assign you to a specific health classification. This is the moment of truth. These classifications are what ultimately determine your price. While the names vary slightly between companies, they generally fall into a few tiers. The top tier is usually Preferred Plus or Super Preferred. This is for the Olympic athletes of health, people with pristine medical histories, ideal height-to-weight ratios, perfect cholesterol and blood pressure, and a clean family history. These people get the absolute lowest prices. The next tier down is Preferred. This is still for exceptionally healthy people, but maybe there's a minor issue like slightly elevated cholesterol that's well controlled, or a family history of cancer after age 60. The price is still excellent, just a bit higher than the top tier. Then you have Standard Plus and Standard. This is where the majority of people land. You might be a little bit overweight, have blood pressure that's on the higher end of normal, or have a well-managed, non-threatening health condition. These are still good ratings that offer affordable coverage. Below Standard are the Substandard, or Table ratings. These are for individuals with more significant health concerns like a recent cancer diagnosis, diabetes, or a heart condition. The price is higher because the risk is higher. The ratings are often given as a letter or a number, like Table B or Table 2, with each step down representing a 25% increase over the standard rate. So Table B would be Standard plus 50%. The difference between these tiers is massive. For a 35-year-old male seeking a $1 million 20-year term policy, the difference between a Preferred Plus rating and a Standard rating could be over $500 a year. Over the 20-year term, that's a $10,000 difference. Moving up just one single health class can save you thousands. This is why understanding this process is so critical. It's not just about getting approved. It's about getting the best possible rating to secure the lowest possible price. You are not just a passive patient waiting for a diagnosis. You are an active participant in a data-driven negotiation for your financial future. But what happens when this black box of underwriting spits out a result you don't like? What if you have a health condition, a dangerous hobby, or a less than perfect family history? Are you just stuck with the rating they give you? Absolutely not. In fact, this is where the real strategy begins, and where having the right guide can make all the difference in the world. Think of the life insurance application process not as a final exam, but as a matching game. Your unique health and lifestyle profile is one piece of the puzzle. The insurance company's specific underwriting guidelines are the other piece. The goal is to find the perfect match. If you only talk to one company, you have exactly one piece to try and fit. It either fits perfectly or it doesn't. But what if you had access to 50 different puzzle pieces? Your odds of finding a perfect fit just went up exponentially. This is the fundamental difference between going directly to a single insurance carrier, what's known as a captive agent, and working with an independent broker. A captive agent works for one company. Their job is to sell you that one company's product. They can be great people, but their toolbox is limited to what their employer offers. An independent broker, on the other hand, works for you. They are not beholden to any single carrier. Their job is to take your specific profile and shop it across the entire market, dozens and dozens of A-rated companies, to find the one that will look at you most favorably. And this is where the secrets of the industry are hidden. Because here's the truth. Every single insurance company has its own unique appetite, its own little quirks and specialties. They are not a monolith. What one company considers a major red flag, another might see as a manageable, everyday risk. An independent broker is like a master matchmaker who knows every carrier's personality inside and out. Let's make this real. Imagine a 45-year-old man. Let's call him David. David is in pretty good health, but his doctor recently put him on medication for high cholesterol. It's well controlled, his numbers are great, but it's on his record. David goes online and gets a quote from company, a big household name he sees on TV all the time. He applies, goes through the medical exam, and a few weeks later gets his offer, a standard rating. He's disappointed. He thought he was healthier than that. The premium is 30% higher than the preferred rate he was quoted. He almost gives up, thinking that's the best he can do. But then he speaks to an independent broker. The broker listens to his story and says, "Okay, Company A is notoriously strict on cholesterol, even when it's controlled. But I know for a fact that Company B and Company C specialize in this. They actually see controlled cholesterol as a sign of proactive health management. They believe you're less of a risk because you're on top of it." The broker submits applications to those two companies. The result? Company B comes back with a preferred rating. The exact same $1 million 20-year term policy is now $60 a month cheaper. Over 20 years, that single piece of insider knowledge just saved David over $14,000. This isn't a rare exception. This is the norm. The industry is built on these niches. Are you a scuba diver? Some companies will automatically add a hefty surcharge, called a flat extra, no matter how safe you are. But other carriers will give you their best rates as long as you're certified and don't do deep wreck or cave diving. An independent agent knows which is which. Do you have a family history of heart disease? Maybe your father had a heart attack at age 58. Many carriers will hear that and immediately block you from getting their best, preferred plus rates, period. It's a hard and fast rule for them. But a savvy broker knows a handful of carriers who will say, "Wait a minute. Let's look at the applicant themselves. Have they had a recent cardiac stress test? Is their own blood pressure and cholesterol perfect? If so, we'll ignore the family history and give them our best rate." This knowledge is the difference between a good policy and a great one. Let's talk about one of the most common issues, weight. Most people think all insurance companies just use a simple height and weight chart based on BMI. Many do. But what if you're a former athlete or someone who lifts weights? You might be incredibly healthy with low body fat, but the BMI chart flags you as overweight. You could be unfairly penalized with a higher premium. A good broker knows which companies use more forgiving build charts instead of a strict BMI, and which underwriters are empowered to look at the whole picture. They can literally save you thousands just by knowing which application to fill out. It even applies to mental health, a topic more important now than ever. Let's say you've been treated for anxiety or depression. It's well managed, you see a therapist and you're thriving. Some insurance companies see that on your record and get nervous, immediately bumping you down to a standard or even a substandard rate. But other, more progressive companies have become experts in underwriting for it. They understand that seeking help is a sign of strength and responsibility. As long as your condition is stable and well documented, they will gladly offer you their best health classes. You just have to know who to ask. So, the first and most powerful strategy is simply choosing the right guide. Someone who has the entire map of the industry, not just one corner of it. But the strategy doesn't stop there. What happens if you do apply and you get a rating you don't think is fair? You are not stuck. This is not a final verdict. You have the right to appeal. An experienced agent can work with you and the underwriter to ask for a reconsideration. Maybe the initial information was incomplete. Maybe you've made positive changes since your application. For example, if you were rated up for high blood pressure, your agent can help you document a few months of better readings and submit them. If you were classified as a smoker because you smoked the occasional cigar, your agent can argue for you to be reclassified as a non-smoker with certain carriers. This is an active, dynamic process. You can fight for a better outcome. But the ultimate pro-level strategy, the one that truly separates the experts from the novices, is something called an informal inquiry. Instead of you formally applying to a company, getting a medical exam, and having a decision permanently attached to your record, a good broker can take your specific health profile anonymously and shop it to a dozen different underwriters behind the scenes. They can present your case to the people who actually make the decisions and say, "I have a 52-year-old male non-smoker with this history of sleep apnea that's treated with a CPAP machine. If he were to apply, where would you likely place him?" The underwriters will give a tentative offer, a likely rating class, based on that information. The broker can then come back to you and say, "Okay, out of the 15 companies we checked, Company X gave us the best tentative offer of preferred. They are our target. Now let's go through their formal application process. This is a game changer. It allows you to test the waters without any risk. It prevents you from getting an official decline or a bad rating on your record, which other companies can see, and it ensures that when you do formally apply, you're doing it with the company that has already pre-qualified you for the best possible result. It's like knowing the answers to the test before you even sit down to take it. This is how you turn the tables. This is how you move from being a passive applicant hoping for the best, to the empowered driver of the process, ensuring you get the absolute best price not just by a few dollars, but often by hundreds or even thousands of dollars per year. It's about knowing the rules of the game and, more importantly, knowing the tendencies of every single player on the field. Once you've used these strategies to lock in that rock-solid 20-year term policy at the best possible rate, you can feel secure knowing your family is protected. But what happens during those 20 years? Can the policy change? Can it do more for you than just pay out if the worst happens? And the most critical question of all, what happens on day 1 of year 21 when the term is over? The end of the term is not the end of the story, and the choices you have at that moment are some of the most important and least understood in all of personal finance. You've spent 20 years paying your premiums, faithfully holding up your end of the bargain. You've successfully shielded your family through the most vulnerable financial years of their lives. The mortgage is nearly gone, the kids are through college, and your retirement accounts are looking healthy. The need for that massive death benefit has hopefully vanished. So what are your choices on that first day of year 21? Let's start with the most dangerous option, the one that trips up thousands of people who simply aren't paying attention. It's the default setting on most term policies. The policy doesn't just evaporate. Instead, it often automatically converts into something called an annual renewable term or ART. And the price of that renewal is, to put it mildly, shocking. The insurance company has been on the hook for your $1 million policy for 20 years, charging you a level premium based on the health of a much younger you. They've fulfilled their promise. Now the deal has changed. They will graciously allow you to continue your coverage, 1 year at a time without a new medical exam. But they are going to charge you a premium based on your current age. Think about it. You're 20 years older. Statistically, you are far, far closer to the end of your life than you were when you first signed up. The risk for the insurance company has skyrocketed. And so, the premium skyrockets too. That $100 monthly premium you were paying, it could easily jump to $1,000 a month. The next year it could be $1,200. The year after that, $1,500. It's designed to be prohibitively expensive. It's the insurance equivalent of a car dealership service department charging you $500 for an oil change. They'll do it, but they're sending a very clear message. This is a financial landmine, and the only way to avoid it is to be proactive and make a conscious choice. So what's the first and often best choice you can make? It's the simplest one: do nothing. Let the policy expire. Just stop paying. This isn't an act of failure. For most people, it's the definition of success. It's mission accomplished. You bought a 20-year tool for a 20-year problem. The problem is now solved. Your children are financially independent. Your spouse would be okay without your income. You have enough in savings and investments to be considered self-insured. Letting the term policy lapse is like taking down the scaffolding after the building is finished. You don't need it anymore. You celebrate the finished building. You don't mourn the removal of the temporary support. This is the goal. This is the plan working exactly as it should. You walk away, having received 2 decades of priceless peace of mind for a relatively small cost. But what if your situation has changed? What if you still need life insurance? Maybe the 20 years went by in a flash, and you still have a mortgage or other debts. Or maybe you just want to leave a legacy for your children or a favorite charity. If you're still in good health, your next option is straightforward. Go shopping for a new policy. You can apply for a new 10-year term, another 20-year term, or even a permanent policy. Now, because you are 20 years older, it will be more expensive than the policy you just finished. That's a given. But if you've maintained your health, it will be infinitely more affordable than that automatic, sky-high annual renewal rate we just talked about. You'll have to go through the underwriting process again, the medical exam, the blood work, the questions, but it puts you back in control, allowing you to buy the right amount of coverage for your new stage of life at a competitive price. Now we arrive at the third option. And this is the one that so few people know about, but for those who need it, it's not just an option, it's a lifeline. It's called the conversion privilege. Buried in the fine print of most but not all term policies is a clause that gives you the right to convert your term policy into a permanent policy, like a whole life or universal life policy, without proving your insurability. Let me say that again because it's that important. Without a new medical exam. This is the policy's secret weapon. It's a financial get-out-of-jail-free card. Why is this so powerful? Let's imagine a scenario. You buy your 20-year term policy at age 35, in perfect health. At age 50 you have a heart attack. You survive, you recover, but your health is permanently changed. You are now, for all intents and purposes, uninsurable. No insurance company will sell you a new policy at any price. As you approach the end of your 20-year term at age 55, you're filled with dread. You still need coverage. Your financial plan isn't complete. Your spouse is still counting on that protection. Without the conversion privilege, you'd be out of luck. Your policy would expire, and your family would be left vulnerable. But with the conversion privilege, you have a golden ticket. You can go to your insurance company before the term ends and say, "I want to exercise my conversion right." And they are contractually obligated to give you a brand new permanent life insurance policy for the same death benefit amount, or less. They cannot ask you a single health question. They cannot make you take a medical exam. They cannot turn you down. They must issue you the policy based on the standard health rating, or even better, based on the Preferred Plus rating you qualified for 20 years ago. The premium will be higher, of course, because it's for a permanent policy at your current age of 55. But you're getting coverage that nobody else on earth would sell you. You are turning a temporary promise into a permanent one, precisely at the moment you need it most. This single feature can be the difference between financial security and financial ruin for a family. It's a backup plan for your backup plan. Even if you don't develop a major health issue, the conversion privilege can be a strategic tool. Perhaps you've become very wealthy and now have a need for permanent insurance to help your heirs pay estate taxes. Or maybe you simply want to guarantee a payout to your children or a charity, no matter when you pass away. The conversion lets you lock in that permanent coverage using the health status of your younger self, giving you options you wouldn't otherwise have. So, as the sun sets on that 20-year term, you stand at a crossroads with 4 distinct paths. Path 1 is the default, the dangerous one. Let the policy auto-renew at a catastrophically high rate. This is the path of inaction. Path 2 is the ideal, the planned destination. Let the policy lapse because you no longer need it. This is the path of success. Path 3 is for those who are still healthy and still have a temporary need. Shop for a new competitive term policy. This is the path of practicality. And Path 4 is the hidden escape hatch for when life throws you a curveball. Exercise your conversion privilege to get a permanent policy, regardless of your health. This is the path of resilience. Understanding these 4 paths is the final crucial piece of the puzzle. A 20-year term life insurance policy is more than just a contract you sign and forget. It's a 20-year strategic relationship with your future self. It's about having the foresight to protect your family during their most vulnerable period, and having the wisdom to know what your options are when that period is over. The peace of mind it provides isn't just in the death benefit. It's in the choices it preserves. It's knowing that for 2 decades, you've built a fortress around your family's future. And at the end of it all, you hold the keys to what comes next. It's not just about buying a policy, it's about buying time, buying options, and buying the certainty that no matter what happens, you had a plan.